Hello, trading in the market is a little bit like playing golf. Your biggest enemy, your biggest challenger is actually yourself, because in the market, like in any other sport, it's really overcoming some of your own issues, some of your own problems that really counts. And Nabil Mattar from IG Markets is here to tell us a little bit more about it. Because as we know, when you're starting out as a trader, it's really overcoming some of your own baggage, your preconceptions that you need to overcome.
Yeah, exactly. I think when a new trader starts getting involved in the market, one thing he needs to be aware of is that trading, to be a good trader, it takes time. All right. Let's say you want to be a heart surgeon. You don't expect to go to the bookshop, borrow a few books, attend a course, and operate on a live person after a few months. It doesn't happen. But the funny thing is that when it comes to trading, people believe that they can do it. Now, why is that? Because if you look at trading, winning is actually easy. Now, why do I say winning is easy? It sounds controversial, but winning is easy because the only skill that you need for winning is to know how to click a mouse. You have a buy, you have a sell, and you just click buy or sell. Essentially, it's 50-50, isn't it? So winning is really easy. But the challenge for trading, or the objective of being a good trader, is not winning, but is winning consistently. Now, there's a big difference between winning and winning consistently. So let me just give you an example.
I know the example straight away. You win sometimes, but you lose all the other times.
Exactly, exactly. So it's not just one trade. No? So like recently, I think last week, the Hang Seng went up 5% in one day. Really big move. And I have a client who started his account at $800. It went up all the way to $10,000 in like 2 to 3 hours. So on one side, awesome money. I won $10,000 in 2 hours. But on the flip side, if you think about it, he's risking $800 to make $10,000 in 2 hours. That's over leveraging. And if he uses his method in out of 10 trades, it just requires one losing trade to blow his account. So that's not very consistent, isn't it? So you see a difference between winning and winning consistently. So a new trader have to focus that the game is consistency, not just one big win.
Okay, so how do you take the emotion out of your trades?
It's easier said than done. That's why, I mean, when it comes to psychology, it's always time. It's conditioning. It's just like forming a habit when you go for a run every morning. In the beginning, it's really tough, but once you click, once your mind's conditioned, every morning you wake up, put on your shoes, go for a run. So same thing for trading. It's all about psychology. It's all about habits, and you need to be aware. That's why trade journal comes to play. Self-reflection. And you need to be aware of your bad trading habits and basically condition yourself to become a better trader. The
funny thing is, we all think that we know ourselves until we look back and think how much better we know ourselves today than we did last time. It's probably more about knowing what you don't know, or having an appreciation for it.
Exactly. When it comes to trading, self-reflection is very, very important. And it's more like a self-awareness, because when your emotions are involved, I mean, same thing in a relationship. When you go through a bad patch, you get very emotionally involved, you don't know what you're doing. Same thing for trading, when you're losing a lot of money, when there's a lot of money at stake, when the market is moving, very volatile, you just get so emotionally involved that you can't really self-reflect. You can't look inward and see what's happening.
Okay, but your premium client manager, do you find that your premium clients are better at this?
When it comes to psychology, whether you're a premium client or just a client by itself, is the same. It's all psychology. In fact, premium clients, I mean, the bigger clients sometimes have a tendency to be a bit more overconfident, because I guess the amount of money that they have, and they try to beat the market. This can be quite risky as well.
Okay, so it's almost an advantage to be just starting out and perhaps not having that much money to trade.
Yeah, I think whether you're rich or you're just not that rich, I mean, the main thing is mindfulness. I mean, being aware of what's happening and knowing that trading is not just following an indicator or just a strategy. It's a lot on psychology.
Yes, but you're not on your own, right? Because there's always the platform that then helps you with the tools that you need in order to actually kind of enforce that dispassionate look at the markets.
Yeah, exactly. I mean, that's where brokers like IG comes in to help you. Of course, we've got seminars, got platform. I touched a bit on the trading tools that we have, but I'd just like to emphasize a bit in current trading conditions, right? I mean, if you look at the euro dollar, for example, I mean, it dropped 2,000 pips in a matter of 6 months last year. You look at the Dow Jones, you look at S&P, you look at the DAX, the Nikkei, everything has been very trending, and the momentum is very strong. So as a trader, right, I mean, if you are on the wrong side of the market, you need to be disciplined and you need to know how to get out. And when I say get out, means you need to know how to cut your losses. But easier said than done, because a lot of traders I speak to, there's this mental barrier that prevents them from cutting their losses, because they always hope that the market will come back for them. And I use the word hope. And hope is a very, very dangerous thing when it comes to trading.
Yes.
Yeah.
Same with relationships, but that's another story. Let's then talk about stop losses, because I think we all know what a stop loss is. It's a sell order that ensures that you stop your losses before they really hit home.
Yes.
But what happens in cases like when the Swiss Central Bank recently announced detaching the Swiss franc from the euro?
Yeah.
And we saw, we saw a whole lot of losses, and we read about this in the newspaper that some of your competitors in the market didn't fare too well.
Yes.
To say it lightly. So, I mean, is there any way that as a trader you can prepare for black swan events like this one?
Yeah, I think good thing you brought up the Swiss National Bank incident, because it brings about a whole new perspective of how important stop losses are. I mean, it moved 4,000 pips in a matter of 20 minutes. This is really unprecedented. And
we'll put that into perspective. What is the usual movement?
I mean, if it's just like let's take the NFP, the non-farm payrolls, the one of the biggest news events every month. Probably a couple hundred pips in there, but this is in thousands.
Right.
So it's really unprecedented. I've not seen it. A lot of my colleagues who have been in the market for a long time have not seen such moves as well.
Which is why so many people got wiped out, and companies too. But how do you protect against that?
Well, as a trader, of course, you got your usual stop losses. We all know that. I mean, a stop loss order is to help you get out the market. It's like a worst case scenario, right? But the thing about a normal stop loss is that it doesn't protect you from slippage, it doesn't protect you from market volatility, it doesn't protect you from gaps. And all this can happen, like the Swiss National Bank incident showed. So what IG has, we have something called the guaranteed stop, which basically, as the name implies, guarantee.
Right, and you've got a chart here. So talk us through it. What do we see on this chart?
So for example, we have a capital land stock here. So if you see the blue arrow, so you know that the market is going up and you want to buy. So let's say you enter a buy at 3.75.
Okay, and before you take that as a stock recommendation, it isn't, because actually this is from a couple of years ago.
Oh yeah.
Okay, but anyway, historical chart. Anyway, for this example, so you buy, and we can see the blue arrow there. We can see that first line, buy at 370.
Yes, so buy at 370. And of course, it's always good to have a stop loss. So let's say you have a stop loss at 370. Sorry, the buy is 375, the stop loss is 370.
Right, there it is, yes.
So now what happens is that the market goes up, happy days, and it goes into a weekend, and when it comes to stock market, there's always gaps on the Monday morning. All right, it can be because of news announcement, or So what happens is that Monday morning, the price gaps down all the way to 350 or so.
Okay, gaps down. Here's something for you if you haven't heard this term before. It gaps down. So what we're seeing here is that the opening price on the Monday is far below, kind of detached. I guess that's where the word gap comes from, right? Exactly. This gap opens up between Friday's close and Monday's open.
Yes.
Okay, so why is this extraordinary?
Because, that's where the guarantee stop protects you. Because the guarantee stops, like I say, it guarantees the price that you can exit. So even for such market, when the market gaps down, our stop, we will fill you at 370 as what you want.
You will get us out at 370. But how is this different from other stop losses?
The other stop losses is that if there's a gap down or the market is very volatile, we will fill you at the next best price. So for example, the Swiss National Bank incident, the next best price can be 300 to 400 pips away. And that can be quite painful. Right,
so you wouldn't get it at, to take this example, 370, you would get it at far below that.
For guarantee stop, we guarantee you at the price that you want for a stop loss.
Right. Okay. And you're talking about this at Singapore Investment Week in late November. What other sort of things will you be talking about?
We probably give a bit of a market outlook of what to expect, because there's a lot of question marks about the market at the moment. I mean, I was just having a chat with my analysts. There's a big discourse between what's happening fundamentally and what's happening in terms of sentiment driven. So a lot of people are scratching their heads like, when is this rally going to end? I mean, when you talk about the indices, right, you got the Dow Jones, the S&P started rallying, I think, in 2013, 2014, and then move on to the European markets, the DAX, the CAC, it shot up a lot earlier this year. And then just last week, Hang Seng took over and it starts shooting up as well. But if you really go inside into the fundamentals of this economy, it's really not doing well. So people are scratching their heads. It's like, it's not more investment 101. It's not like when economy is going up, the market is going up. This is a totally different thing altogether. So it's a bit tricky. I see a lot of clients getting confused by it, trying to trade fundamentals and getting caught by the sentiment moves. So we're trying to address that in the coming seminar. All right. Thank you very much, Nabil Mattar. And you can catch more from IG Markets at the Singapore Investment Week. The website's on your screen now. Go to this website to find out when IG Markets are speaking and all the other presenters at Singapore Investment Week.